Hey, LinkedIn, and welcome to Business Unusual, where we're talking with you about how the coronavirus is impacting the ways that we all work. I'm Caroline Fairchild, coming to you from my home office here in New York City. We are starting to get indications from all sides about how COVID-19 is impacting the economy, and we know that it is monumental. Whether we're looking at hiring, the markets, or how this is impacting all of our personal finances, it is clear that we are in unprecedented times. St. Louis Fed President James Bullard said over the weekend that the U.S. unemployment rate could rise to as much as 30%. GDP could go down to about 50% in the second quarter. These numbers are huge, and I'm having a lot of anxiety about this news, and so I thought that we could talk about this together. What I thought we could do with today's show is bring in some experts who can really break down for what this all means for us, for the economy, for our finances. We could have a conversation about that together on the show. We can't do that without you. The whole reason the LinkedIn editorial team put together this show is to have a conversation with you about what COVID-19 is meaning for you and your world, what this means for you as a worker, as a job seeker, and really just as a human. And so we want to have a conversation with you. I'm in the stream right now seeing people coming in, talking to us, and we want to have a conversation with you. So please, if you have questions or comments about COVID-19, we have experts from a variety of different backgrounds coming on today's show to talk directly to you. So let's get directly into that. I want to bring in LinkedIn Chief Economist Karen Kimbrough, who's joining us from her home in California. Karen, thank you so much for joining us.
Good morning or good afternoon. Thanks for having me.
All right, so LinkedIn just came out with some new data on how COVID-19 is impacting the hiring market. Walk us through this data. What are we seeing?
Sure. So we have, I guess, the fortunate position of being able to see how the labor market is responding kind of in real time, or even a little bit of a preview. Because we're able to see hiring data, we're able to see, posting data, job posting data. And what we're starting to notice is two things. One, in the hiring data, we're seeing that in countries or localities where they've had a lockdown, there has been a significant slowing in hiring. That's probably no surprise to people. But when we look at, for example, China, and then later on Italy, what we've seen is as much as a 40% decline week over week in hiring activity. And so starting from the moment at which there's a lockdown, we can start to count down how hiring activity starts to decline by our data. So that's not surprising, but also not the most happy of news. The other thing that we're observing is coming from our conversations with companies that we talk to and work with. And they're starting to implement hiring freezes or starting to just sort of pause or slow the pace of hiring. So what we're seeing is a slower time to hire, mainly because companies are making those decisions about pausing, or because the interview process is just getting more protracted by the fact that we're all at home and trying to navigate things over, the video. So those are the two things that we're observing so far. And I can tell you we're starting to see early indications as well in the US, because we know we're about a week behind or 2 weeks behind Europe, that hiring is starting to slow a little bit here too.
Right. You mentioned China, you mentioned Italy. These are markets that are obviously far ahead of us in terms of what is in store for the economy. Can we learn anything from what is experiencing there in terms of here, and how are the markets different?
Sure. So what we see, as I mentioned, is like in the first, week or so after the lockdown, you see growth go down like almost 40% on a year-over-year basis. But the good news is that as a company or a country, starts to get on top of the virus, starts to feel like the containment is actually being a little bit successful, the numbers improve. So in China, in the last 5 weeks, we've started to see a real improvement in the hiring data. As I said, it went down in that kind of very deep dip of like 40% year on year declines in hiring. And now it's starting to kind of trace its way back up. And so for the 5 consecutive weeks in the past, we've seen this improvement, and we consider this a good sign. It's a sign of things returning to normal over time. And I kind of think of it as like a check mark, where you have a very deep initial decline and then a sort of gradual retracing back up to where you were. And that's what I think we're going to experience, not just in China, but also in Italy and eventually in the US. But you did ask what's different. And I think What's the same is that everybody has to sort of shut down. The lockdown affects everybody sort of equally. Things pretty much pause with the exception of essential services. What's different is how we think about our labor markets. And I think what will determine whether or not we end up in a really, really deep and painful recession that's protracted, or a somewhat maybe deep but short-lived one that we kind of manage to get out of pretty quickly, is how our labor market can respond. And so to the extent that we can avoid laying off everybody all at once massively, that's a good thing. And you'll see that in European markets, their labor markets are less flexible, but they're also more likely to hold on to jobs and preserve those jobs. And they have a lot more packages out, fiscal packages, to ensure that people aren't laid off right away. So they're doing a lot of income support via companies. We're not yet seeing that in the US. Our labor markets are traditionally been complimented for being extremely flexible. We can sort of hire and lay people off pretty easily. So for good or bad, it means our labor markets are flexible, can adjust easily. But when you have an exogenous shock like this, it's really, frankly, not really anybody's fault. It just happened, and it happened to everybody. I would argue that it would be awesome to have a fiscal policy that sort of provides a little bit of shoring up of income for everyone, mitigates maybe the layoffs that companies are going to want to feel inclined to do. Because the minute that the virus is over, we should expect to return back to normal. And we don't want to see companies kind of lose valuable time trying to rehire people and retrain them. It would be better if they could just sort of keep them, so to speak, at home and on the ready to get back.
You mentioned a potential fiscal policy to kind of help us through this time. Right now, we're having reports that a stimulus package of up to $2 trillion could come as much as today. Have you given thought into how that stimulus package could impact the hiring market, even the short term and long term?
Sure. So ideally, let me start by saying it would be great to have a fiscal package. We've seen a lot of monetary policy coming out of central banks. They've cut rates, they've offered to buy bonds, but it's not going to be enough. What the stock market wants, what financial markets want, what people want is real support for households in Main Street. This is a recession that's hitting Main Street, not Wall Street. The recession of 2008, 2009 was really a Wall Street phenomenon. It hit housing, but it really hit the banks. This one is hitting people, and it's hitting labor markets in particular. So the cure for that is going to be fiscal policy. It would be fantastic if we had a package that came through. I will tell you, the initial reports of $1 trillion that were maybe a week ago, I was like, that's too small. We have an economy here in the US that's $22, $23 trillion. $1 trillion is not enough for a quarter of contraction. So it would be great if it's $2 trillion. It'd be great if it's more than $2 trillion. The numbers I'm seeing amongst economists are saying $4 trillion would be ideal. So that gives you a sense of, like, even if we get $2.5 trillion, I won't be satisfied. I'd like to see more. I'm not sure that will happen. What will be helpful in any fiscal policy of any size is anything that helps companies, especially small businesses, Main Street, stores, shops, services that have to close down right now, anything that helps them bridge this gap right now. So anything around income support for employees, or any kind of support in terms of giving them a break on rent or loans or utility or standard bills, all of this will help, because frankly, this is not a recession caused by an imbalance in our economy where we did too much of something, we enjoyed ourselves too much at the punch bowl. This is really an exogenous and external factor that hit the globe and it's affecting every country one by one. And so there's nothing to adjust to other than just to get through it and hope that we get a vaccine, hope that we get some palliative treatments, and hope that our medical system can accommodate the number of people who are going to need help. So a fiscal policy that bridges that would be fantastic.
Right. And for those of you who are just joining the stream, I'm here with LinkedIn's chief economist, Karen Kimbrough, and we are talking about how the hiring market is being impacted by COVID-19. If you have questions about that, about personal finances, or what's going on in the markets, let us know in the stream. We'll get your questions answered on today's show. Karen, you mentioned that the $2 trillion stimulus that could be proposed as early as today may not be enough. You'd like to see $4 trillion. I saw Minneapolis Fed president say over the weekend on 60 Minutes that millions of people could lose their jobs. Is there any hope right now in terms of what we're seeing, or how can we kind of reframe for the people on the stream who have a lot of anxiety right now about what's to come?
Sure, and I apologize. Economists are not known for like providing soothing words. The only time that people want to talk to economists are when things are bad. They're like, "What's going on?" But let me try to provide some.
Thank you. We all appreciate it. The LinkedIn community appreciates it.
Absolutely, I need it too. I was watching a video last night at home in bed of just, I think it was about farm animals. It was like something not to do with
Can you
this.
send me the link? I'd love to watch it.
Any videos, I'll share it with you.
Great.
So here's some good news. One, the U.S. economy is incredibly resilient. When we do get through this, and we will, we're going to bounce back pretty quickly. I'm not going to say everything's going to go back to 100% right away. It will take some time, but we will bounce back. There was nothing wrong with our economy when we came into this. At the beginning of the year, all economists were unanimous in agreeing that the U.S. was in a great spot, and frankly, so was most of the rest of the world. There were a lot of bright shoots on the economy's landscape for Europe, for Asia, even for Japan, for South Korea. People were very, very optimistic. So we're starting from a point of strength, and we're taking a punch right here, but I think we're going to bounce back. The other thing I would say, I'll leave you with this, is that although we are already starting to see layoffs and job losses, particularly in travel, in dining, in hospitality, that's to be expected. Two things. One, people are going to want to go back. They're going to want to eat out. They're going to want to travel. They're going to want to enjoy services as soon as they can. So these things are not going away. They're just being interrupted for the moment. They will come back, and people are going to be ready to eat out, I'm sure, as soon as they can. The second thing I would say is that there are also a lot of jobs that are being posted, and we're seeing an increase in job postings in healthcare, unsurprisingly, but also we're hearing reports of a lot of job postings for pizza delivery services and drivers to deliver food. So there are a lot of job postings out there that could provide mini bridges for certain sectors of the economy that are getting laid off from, say, a restaurant. Maybe you could deliver food, or you could shelve items at a grocery store. These are all places where we're seeing a lot of hiring actually spike.
Well, Karen, thank you so much for providing that perspective and joining us on Business Unusual.
Sure.
Great tips about what this really means for communities around the world. Kate, thank you so much for joining us.
Thanks for having me.
I heard you couldn't hear me, but you can hear me now, right?
I can hear you now, yeah.
Great. All right, so I asked Kate to come on because she really has a variety of different perspectives as a former banking exec, as well as a business owner right now. And before we really talk about personal finances, Kate, I was just talking to Karen about layoffs and hiring. Can you bring in the small business perspective about how small businesses are thinking about this on the ground right now?
So I think the first thing is, where do we come out of this, and when is that actually going to happen? You know, when we started in this, it was a couple of weeks. I think now you hear every single day different timeframes. And as a small business owner, particularly those that rely on cash flow every single month in their business, your hospitality, restaurants. I manage a physical space for professional women. You know, we rely on people coming in, events producers, caterers, florists. These are issues that small business owners are facing, and not knowing the time frame as to when they might come out of this is mentally exhausting. How do you handle your staffing, your payroll? And Karen alluded to it earlier, just around looking at if you have a rent, if you have vendor payments. It's just overwhelming, and the time frame issue causes a lot of stress. So I see this as, you know, you can look at some great positives here, but the challenge right now is we just have no time frame. And most small business owners, if you look at it today, particularly women owned, almost, depending on the Visa or American Express study, 64 to 71% of women-owned businesses are actually bootstrapped or self-funded. They don't have access to lines of credit or loans, or the majority. So they, again, rely on cash. And where's that cash coming in?
Cash flow is definitely a problem, and I've seen those same stats well as about women-owned businesses. But there's also this stat that I read over the weekend about most Americans don't have even a fund to stave off some sort of emergency. Is there any way to kind of build an emergency fund for your business while an emergency is happening? What do we do for the businesses who don't have that money, that cash flow coming in, and now trying to make decisions during a time of unprecedented uncertainty?
Yeah, so I think the first thing is understanding what your cash flow position is and how long that can stave off any fiscal challenges. You know, where's your liquidity position? I think number two is look at your expenses. I mean, if you haven't done that yet, you should be doing that now, and understanding what are the must-haves that you have to pay and what are those that are the nice to have. And I think, you know, contract negotiation is critical right now. Reaching out to your vendors, reaching out to your landlords and saying, listen, is there an opportunity for a deferral or a suspension of payment for 1 to 2 to 3 months, depending how long this happens? I think a lot of business owners have business credit cards. And again, coming from my financial background, you know, one of the things that we used for consumers is a payment holiday, where your balance is frozen, you still have access to your credit line. Business owners should be reaching out to their bank, their relationship managers, their credit card providers, and saying, what can you do for me in this time of stress? And finally, again, looking at your expense management is super critical. Part of that is going to be your staffing. If you have staff, if you've got, you know, payroll to pay, what are you prioritizing over this 1 to 2 to 3 month time period? I think there are some incredible resources that are popping up. You've got, you know, Amazon has the Neighborhood Small Business Relief Fund and to help businesses in Seattle. You've now got Salesforce taking the lead out in San Francisco and getting people to actually fund these grants for small businesses. Facebook announced the 100 million, and then the Small Business Association, right? Historically, it hasn't been that easy to get a small business loan. Now they're trying to pump that into the economy and expediting. And I think asking your other friends that are in or in your network of founders and entrepreneurs and small businesses to see what they're seeing out there, regardless of where you're situated.
So there are funds out there. It's just a matter of being proactive in terms of finding them. On the personal finance side, for the non-business owner, you just led a webinar tutorial of sorts called Don't Touch Your Face, Don't Touch Your 401k.
Yeah.
Walk us through how members on the stream should be thinking about their personal finances right now and why we shouldn't, you said not even to be looking at your 401k right now.
Yeah, we had this, again, we've now, again, coming from a physical community to moving very quickly to a virtual online community. We had I think a really important conversation with UBS, which is one of our corporate partners, and Kathy Entwistle, who's a senior portfolio manager and wealth advisor there, and said, you know, don't panic, right? We've been through this before, whether you were going through it through 9/11, you've gone through it through the 2008 financial crisis, don't panic. How do you feel in control during this time? We will come back. The best thing that you can do, if you are able to do it, is leave your 401k and your retirement alone, and look at, again, what is your emergency funding? What is your emergency plan? It's really important to have a plan. Does that give you a month? Does that give you 3 months? Does that give you 6 months? But I think not looking right now, particularly if you are super concerned with where you're at, is important. I do think getting an overall picture of your finances is important. And so taking stock in what do you have in your checking and savings account? What do you have in your retirement fund? Do you have investments? So taking the overall picture, but not necessarily tapping into that yet.
You told me that during the tutorial, a bunch of the participants were still putting questions in the stream saying, well, what if I do want to touch my 401k, or what if I do want to change my contributions, which we were talking about, just talks to everyone about the anxiety that we are feeling like we have to do something with our money. How do we stave that off when there is so much uncertainty in the markets right now?
Listen, again, we've gone through financial uncertainty before. I think, again, back to what Karen said, right? Then it was Wall Street, now it's Main Street. But as an individual, you've got to be thinking any short-term gain in tapping into those retirement savings. And again, I'm not a financial advisor. I'm just looking at it given my background. Tapping into that short-term gain will provide long-term pain. That is what you've set aside for your retirement. And again, if you are 5 to 7 years away from retirement, you should be fine. If you're closer, then my recommendation is you better talk to a financial advisor around what you can do today versus what it's going to look like in a few months. We've also got a number of people that are just saying, what is the government going to do for us? Will there be a non-penalty if I do need to tap into my 401k? So paying attention to the stimulus and the packages that are coming out there, both for small business and for individuals, is really important as it pertains to what it means to you and how to bring down some of that anxiety.
And before I let you go, we started this conversation talking about some of the anxiety that small business owners are feeling right now. You are a business owner. There's a lot of uncertainty right now. How are you keeping sane? How are you kind of trying to keep your team sane during this time?
So I think one is we have an incredible community within both the women, the business owners, the entrepreneurs, the professional corporate women that we serve at Luminary. And I think they're providing a lot of anxiety relief for me because they continue to support us through this time of uncertainty. I think you also have to look at this time as, creative problem solve. What were the challenges you were facing in your business before without this? And it gives you a bit of time to think. So I have an incredible team that is jumping in. Again, it took us 48 hours to move everything that we do physically online. We've opened up a Slack channel, a Facebook private group, our proprietary Luminary app. We've also set up a virtual small business marketplace to support small business owners around the world that need sales. So for me, a lot of that, I guess, anxiety is lessened because I'm tapping into our community. I'm tapping into my networks and the resources to say, what are you doing? How are you doing it? And finally, I would say, don't look at this as a time of competition. Look at this as a time of collaboration. We have 10 partner communities of women's spaces around the US. And we've now set up a weekly call in order for us to talk about what's happening in your city. What's the government doing? What are your members saying? So that number one, we're sharing in that anxiety and helping each other. But two, we're sharing advice and tips around what are you doing for your communities? What are you doing for your members? And certainly, hopefully helping each other pull out of this together.
Right. We are all going through this together. That's definitely been a theme that we've been exploring throughout this show. Kate, as always, thank you so much for your perspective.
Thanks for having me.
All right, that was Kate Luzio, the founder of Luminary, talking to us not just about our personal finances, but what this means for business owners on the ground today. If you're just joining us, my name is Caroline Fairchild. This is Business Unusual, where we're talking about how the coronavirus is impacting the ways that we work. On today's show, we're focused on the economy, talking about hiring, personal finance, the markets. If you have questions or comments on any of this, please let us know in the stream. We'll get them answered and talk about them on today's show. This show is for you, so let us know what you'd like to discuss. All right, now I'm going to bring in my colleague, Devin Banerjee. He's our senior finance editor. Hey, Devin, how's it going?
I'm doing great. Thanks for having me.
So big question first, is the stimulus package been announced in the 23 minutes since I've gone live? That's the big question I have.
As of right now, Caroline, about 12:25 p.m. Eastern time, it has not been announced, but the market is really optimistic that it's coming. Dow up about 9% today. That's more than 1,600 points. S&P 500 now up about 8%. This is a very welcome respite in the downturn we've been experiencing. The big question on everyone's minds is this a temporary rebound? Is it a more sustainable rebound? I've got to say the majority of experts I follow and those who are publishing on LinkedIn see it more as just a temporary rebound, what some of them call a dead cat bounce. A dead cat can still bounce off a trampoline or a bear market rally. So people are really going to be looking to the next couple of days after the stimulus to see if this rebound is sustainable.
Right. I mean, the central banks right now seem to be kind of in constant motion. I, as just a news consumer, not a finance expert, have been having a hard time keeping track of what the Fed is doing when. Can you break down for us kind of what are the biggest steps that the Fed is taking right now? How do we read beyond the headlines here?
Yeah, so the Fed, the U.S. central bank is taking a lot of measures very similar to the financial crisis. That's why you keep seeing it labeled crisis era measures. Cutting rates to effectively zero, or a range of 0 to 0.25%, bringing down bank capital reserve requirements, allowing banks to borrow, launching asset purchase programs. But you're noticing a lot of what I'm saying is helping the financial system. And as Karen alluded to earlier, and a lot of smart people are noticing and mentioning, is that this isn't really a financial system, crisis that we're in. This is a health crisis and a supply chain problem. As our colleague George Anders pointed out on the platform a couple of years ago, this is a supply chain problem. Even if we're pumping money into the system, if we're all sitting at home and not consuming at the ballpark or going to the restaurant or jumping on the plane to travel on our vacation to Spain or Italy, all of this pumping of liquidity into the financial system can alleviate the pain, but can certainly not solve the pain.
It's definitely something that's impacting Main Street, as we've talked about on the show, and the liquidity problem that is impacting the supply chain is huge as well. But I want to know, we're seeing hundreds of financial advisors trying to give tips to Americans right now about how they should be thinking about their finances through these unprecedented times. Can you share with the stream some of the best practices that you're seeing?
Absolutely. Our platform has really lit up with some great advice from financial advisors. I'm going to point out just a couple at a high level. And I just want, as Kate said, we are not financial advisors. And, without a full picture of everyone's financial situation, this should certainly not be taken as advice. But some general takeaways. Step number one is acceptance. A lot of people are saying, accept that this is happening and do not become susceptible to what's called action bias, which is a bias to take some kind of action or to touch your 401k or to adjust things just because action is happening around you. Number two is focus on your emergency fund. A lot of financial advisors recommend a range of something like 3 to 9 months of your after-tax take-home pay as a liquid emergency fund. If you have not reached that range, you definitely want to get there. And especially for a potential future crisis, you want to be in that range of 3 to 9 months. Number three, if you are invested, you do want to review your plan. Think about your risk tolerance. That's a word that kind of combines your ability to take risk and your willingness to take risk. And you want to just reassess where you are and see if your investment plan matches that. And number four, the last one I'll point out is accountability. Once you come up with these plans and as you adjust your budget and your spending and your saving, think about a spouse or a partner or a friend or a financial advisor, yes, who can keep you accountable and who can prevent you from becoming susceptible to action bias and prevent you from acting emotionally or with a behavioral bias just because the market is swinging in one way or the other on any particular day.
Yeah, that behavioral bias, I think, is something that we're all grappling with right now. I like Kate's advice, not even look at your 401k right now. I certainly haven't. The individual banks are coming through with some policies as well as pertains to mortgages, credit cards, trying to step in during this time of need. What can we expect moving forward with some of these practices?
Yeah, we have seen the private sector really step up in this regard. Bank of America kind of led the way here in the U.S., allowing customers to apply for leniency on mortgages, auto loans, credit card loans. We've now seen all of the other lenders, or most of the other lenders, I should say, including Wells Fargo, Citigroup, JP Morgan, step up with similar relief measures and programs, Ally Bank as well. So I would just say to those who are watching to definitely check with your bank, check in with your relationship manager, or even on their websites. And there are many ways you can apply for relief or leniency on your debt obligations right now.
Great advice, Devin. And before I let you go, I want to talk about the big R, the recession. I'm not going to ask you when it's going to happen because everyone has a guess, but what signs can we see from certain markets in terms of if there is a recession pending, who's going to be hit the hardest and who's going to be hit the hardest earliest?
Absolutely. So the team here really found a Brookings Institution study, quite insightful last week, looking at where in the U.S. we might see this start to hit. So in terms of industries, we're looking at mining, transportation, employment services, of course, leisure and hospitality, travel arrangements. You can see on your screen right now, according to Brookings, the amount of jobs that are susceptible in a downturn in this regard. And if you kind of map those industries to geographies in the US, we're looking here at kind of the Sun Belt, if you will, a lot of metropolitan areas that are most affected by an oil and gas downturn. So if you're looking at specific cities, we're thinking a lot about Texas, Midland, Texas, Odessa, Texas, Laredo, Texas. This is where E&P explorers and producers of oil are mostly headquartered and where most of their workers, of course, live and work. You're also looking at Hawaii, Atlantic City, and Vegas. Those are where, of course, leisure and hospitality are very prevalent. So definitely, everyone is definitely keeping an eye on these sectors and these metropolitan areas where we may see those signs of a recession first, and we may see them hit hardest.
All right, Devin, well, I know you'll have your eyes open on those markets, and I'm sure this won't be the last time that we have you on Business Unusual. Thank you, as always, for your perspective.
Of course.
All right, that is all that we have for Business Unusual this week. I want to thank our guests, LinkedIn Chief Economist Karen Kimbrough, Luminaries Kate Luzio, as well as LinkedIn Senior Finance Editor Devin Banerjee, for walking us through really what is an unprecedented impact on the economy. This is constantly moving. We don't have all the answers, but a good thing to do is to follow all my guests on today's show. They're sharing great stuff on LinkedIn to keep us all updated through these tumultuous times. I'm Caroline Fairchild. This is Business Unusual. We're coming to you at noon, Tuesday, Wednesday, Thursday, Friday, to talk about how coronavirus is impacting the ways that we all work. Tomorrow, we're going to be talking about the big switch to online events, what that means for you and your ability to stay sane right now during the crisis. On Thursday, we're going to be talking about healthcare. If you have comments or questions about what you'd like to see on this show, please let me know. Follow me on LinkedIn, Caroline Fairchild. Thanks so much for joining us.